Hello, everyone, and welcome to today's webinar. I have the pleasure of having Cole Buller here from Pinon Capital, and today we have a presentation for you. And Cole, do you want to jump straight into it?
Yeah, let's get into it. First off, I appreciate everybody just taking the time to be here today. Sorry, we are slightly late. We were just having some issues with the technology here, but I'm very happy everybody's here. We're going to be diving into details in terms of how Pinion Hill Capital operates, as well as the investment opportunity and everything like that. Also, if you do have questions or anything like that, we will have a Q&A section at the end of this presentation. So just feel free to let us know, and we should be able to answer the majority of questions there. So yeah, I am Cole Buller, one of the directors of the capital markets here at Pinion Hill Capital. And first off, just to let everybody know, this is a accredited only offering. And what that means is you can either qualify by net worth or income. So if you're qualifying based on net worth, then you have to have a net worth of $1 million plus, and that's not including your primary residence. And then if you're going based on income, then it has to be, if you're single, over 200,000 per year. And if you're married, then it has to be over 300,000 per year. So if you are qualifying by net worth, it can be joint net worth. If you're married, you can use essentially anything of value. So rental properties, vacation properties, retirement accounts, bank accounts, essentially anything, just let us know and we can help out with that. But yeah, let's dive into some of the details here. So a little bit about my background. I have been working in the finance and investment space for quite a few years now. I would say I started that journey off at the University of Colorado in Boulder. I studied finance there. After that, I worked in finance at a large loan creditor. I managed a large loan portfolio there and helped out with different financing solutions. And now I've been with Pinion Hill Capital. I've been helping out with raising efforts and also helping with acquisitions as well. So as I was saying, if you have questions, let us know. Also, I will be sure to provide my email as well as phone number. If you want to get in touch with me directly, we can always set up a phone call. We can talk through email, just whatever's easiest for you. So just feel free to let us know there. So yeah, let's get into everything. So first off, so what does Pinion Hill Capital do? So we are a business acquisition company. We're mainly targeting companies in the e-commerce space. So that's both Amazon as well as non-Amazon stores. We are here to make a lot of money, but we recognize that we have a large fiduciary responsibility with our investors. And with that being said, we primarily operate under two main values. Those values are profitability as well as safety. But I would say with that, safety is probably the most important thing to us because we really want to ensure that we're building a growing profitable business, but we do not want to do that at the expense of our investors. So we maintain very safe and stable cash flows. We don't over leverage ourselves because at the end of the day, we want to ensure that our investors are taken care of because without our investors, we can't really expand our business. So as I was saying, our target sector that we're going after, it's the e-commerce space. We think overall it's a great market to be a part of. One, because of the sheer size of this market. We've been seeing phenomenal growth in this area in the recent years, and we expect this growth to continue over the next 5+ years. And as you've probably noticed, everyone's buying things online these days. It used to be, I mean, just in the recent past, it was you would have to go out and buy everything in person. Now, essentially, you can do it with a few clicks with some of these companies like Amazon. So things have really changed to be quite a bit more efficient in the e-commerce space. And we think overall, the really nice thing about the e-commerce space is there's a ton of space for great margins and also just space to grow this business organically while receiving healthy profit margins. So typically there are three main types of acquisitions that we're making here. So first off is existing Amazon as well as e-commerce stores. So those are simply existing stores that someone else has built from the ground up. They're companies that are already selling products. We simply acquire that business and we take over administration, and then we get to take part in the cash flows that that company has to offer. Second up is distribution contracts. So those are contracts that we actually purchase from a wholesale company because in many cases, companies don't have a direct to consumer arm. So what that means is they don't actually sell their products directly to consumers. So they end up relying on companies like us to actually bring their product to market. So what we'll do is we'll purchase these distribution contracts in bulk, and then we'll end up selling them through our existing e-commerce presence to a wide variety of clientele. So a really good example of this that I use quite a bit is L'Oreal Paris. It's a great example. It's a company that has quite a bit of brand recognition. They sell stuff like skincare products, shampoos, conditioners, that type of stuff. But what we'll do, we'll buy those distribution contracts in bulk. And what's really nice is, as I was saying, it has a lot of brand recognition. So it has a very high sales velocity, meaning they move through quite a bit of inventory consistently each month, as well as each year. And then next up is private label products. So those are products that we actually develop ourselves. We manufacture and distribute those products from start to finish. So how that works is we'll go to the manufacturer and we'll tell them we're looking to develop a specific product, and then it's going to be manufactured in bulk. And then we get to market the product ourselves, and we get to keep the cash flows associated with distributing and creating that product. So typically with private label, it does take quite a bit longer since we are doing that process from start to finish. But the really nice thing is it offers quite a bit higher margins. So we mainly have these different three types of cash flow streams working for us here. So yeah, we went over some of the details in terms of what we do on a broad level, but I want to touch upon essentially the economics behind how we do what we do. So the first step with that is discovery. So we want to find good businesses that we can acquire for a good deal overall. But the first thing we look for is a past level of success. So we want to find companies that are profitable, companies that have stable cash flows, because that helps us understand how is this company going to perform in the near future. Next up, we're looking for products that have longevity in terms of what they're selling. We want to find products that are going to continue to sell for the next 10 plus years. We want to make sure it's not something that's going to go obsolete in the next couple of years, because then it wouldn't really make sense for us. And next up, and I would say this is one of the things that's probably the most important, we're looking for minimum margins of at least 10%. Oftentimes we are able to find quite a bit higher margins than that, but that's just simply the target that we try to shoot over is 10%. By really establishing that 10% guideline, it really ensures that we're making money on all the products that we're selling, and we're not breaking even or, selling at a loss or anything like that. Next up, we look for a minimum of $25,000 in sales and also high sales velocity. So as I was saying with that L'Oreal Paris example, we're looking for companies that are moving through inventory pretty consistently each month as well as each year. Because even if we're able to find a product that has a really good margin, if they're not moving through quite a bit of volume, then it's not really too profitable or too helpful for us. So those are some of the main things that we're looking for. And then once we find companies that really fit that criteria, we're going to acquire and scale that brand. So once again, we look to acquire successful, well-run businesses with a great product. But in many cases with these products and these companies, the owner doesn't really have the expertise to fully maximize the value of that brand. So what we'll do is we'll come in, we'll purchase that company, and we'll inject capital into that business. We'll further expand inventory. We optimize marketing to further increase revenues. And then we leverage our existing e-commerce space presence to lower costs and increase profit margins overall. So for example, if we find a business that's selling, let's say 50,000 a month, we might be able to bolster that up to 100,000 just in a few months by making some of the changes mentioned above. So, and here's a really good example, Jasmine lamp. It's a company, they sell at a 10% margin, just a basic bedside lamp, but it's a sales price of $20, $18 in total cost to make this product. So as I was saying, 10% margin on this product. Well, what we'll do in this scenario, we'll go and buy, let's say, 3,000 units of this product. We'll then sell through those units in a couple of months, and then we'll take the revenues received from those sales and we'll recycle it right back into additional inventory. And then we'll just continue to do that process over again. So in this example, we're able to take a 10% margin product, and then we sell through that inventory 4 to 6 times throughout the entire year. So even though it's a 10% margin product, we end up making 40 to 60% rate of return because we're able to just take that margin product and then sell through it multiple times each year. So overall, it ends up leading to a very high net rate of return throughout the course of a year. So as I was saying, because of this high rate of return, as I was talking about, this allows us to pay not only a stable, but just a consistent high return with this offering. So we have 2 specific offerings here at Pinon Hill Capital. So both are on a fixed rate option, and they are going to be 3-year terms. So first off, we have the 10% option, and that pays interest monthly. Next up, we have the 11% fixed rate compound option, and that's going to pay out at the end of the term. So at the end of the 3-year term, you would receive a lump sum back. And both of these options, I do want to say they are secured notes. So that means they are backed by the assets here at Pinon Hill Capital. So it's going to be a first priority position in the capital stack. So it is typically considered a low risk investment. And I do want to note as well, the reason the compound option pays a higher return is because what we can do is we can take the capital that we would normally pay back to investors as interest. And what we can do is we can recycle that capital into further acquisitions. So overall, it's really in our best interest just to pay a little bit of a higher rate of return, just to really incentivize investors to keep their money in that compound option. But obviously, we do know this investment, it really depends on your goals. So that's why we have both of those options for you. So you can just let us know if you have questions on any of those. But that's really the biggest reason that why we have both of those options. And both of these, they are going to stay fixed. So there's never going to be any fluctuation with that balance over that time. Awesome. So as I was saying, this is considered a safe investment. They are secured notes, meaning they are backed by not only the inventory, but also the assets that we have here at Pinon Hill Capital. So it will be first in line in the capital stack, because at the end of the day, we really want to ensure that our investors are protected. I did want to also include just a brief example of what it would look like for an investment. So I just used 100,000 just for the amount, just because typically that's around the average of what most people invest. And then obviously it's just a nice even round number. So by the end of the term with the compounded option, you would have 138,887.86. So that includes the accrued interest as well as the payback of the principal balance over that 3-year term. On the other hand, with the monthly interest option, you would get 833 per month. So that's 10,000 per year. So total interest through the course of that 3 years would be 30,000. So by the end of that 3-year term, the investment would be worth 130,000. So just a nice little example to show you how that would work. And then also, so depending on the size of the investment, we do offer rate lifts. So if you invest over 100,000, you actually receive a rate lift of 1%. So for example, if you invest in the compound option, instead of receiving 11%, you would actually get 12%. And then if you invest over 500,000, then you would get a rate lift of 2%. So in that example, if you invest in the compound option, instead of receiving 11%, you would actually get 13%. And also, if you do invest over $1 million, there can be additional rate lift. Just call us and we can kind of let you know the details with that. And then also, if you want to do maybe like 50K in each option, something like that, you would still get the rate lift because it's about the total amount invested into the investment. So you would still receive the rate lift if you're looking to do kind of a mix of both options, anything like that. So, and then I did want to dive into as well just why we actually pay these rates. So first off, there's a couple reasons we chose this offering as opposed to different options for financing, such as bank financing, public equity offering, a private equity offering, anything like that. So we chose a debt offering as opposed to equity because we recognize that this company is going to be very profitable and we believe it's going to grow pretty substantially over the next few years. And with that being said, we're not looking to give up a ton of equity in order to achieve our financing goals. With this debt offering, we're able to maintain control as well as ownership with the business. And typically, we notice the biggest problem with a debt offering is usually you go through investment banks or third parties, but the fee can be anywhere from 2 to 6% of your overall issuance. So what we're able to do, since we're not paying that fee, is we can just pass it on to our investors in the form of a higher yield. So that's the biggest reason why we chose a private issuance, is because at the end of the day, we can increase our return with our investors. Another option typically for companies our size is bank financing. But the biggest issues here, lots of times there's a lot of hoops you have to jump through. They take a lot of control as well as they place a lot of restrictive covenants in terms of what you can actually do. So, for example, if we were to go and get $1 million from the bank, even if they gave it to us, typically it would probably take 2 to 3 months. But then in 2 to 3 months from now, we would just simply have to do that process all over again. So it ends up being just a very inefficient process, we think, overall. And we think just a much more efficient way to achieve our financing goals was just raising capital this way. Doing it through webinars, presentations, we thought was just a much better way to just grow this business organically just by raising capital consistently throughout the year. All right, so how we are able to pay these rates. So we discussed this a little bit, but essentially at the end of the day, we're netting out at 20 to 30% rates of return after all our expenses. So this leaves us plenty of space to pay our investors back at that rate of 10 to 11%. And as I was saying, we get to that rate of return by taking products with a minimum margin of 10% and then selling through that inventory multiple times each year. So this kind of goes back to that main point that I was discussing earlier about safety. As I was saying, safety is something that's very important. With that being said, we maintain a 5-to-1 cash flow coverage ratio. So what that means is that for every dollar that we're paying back in interest, we have $5 coming in the form of operational cash flow. So it makes it so we're easily able to pay back our investors, not only their interest, but also their principal payments that we owe, because it's very important that we have adequate cash flow because we know that we have these monthly interest obligations. So just to summarize here, the opportunity that we have here at Pinon Hill Capital. So first off, it's the 10% option, and that one pays interest monthly over the course of 3 years. And secondly, we have the compound option paying 11% over 3 years. And as I was saying, if you're looking to do some type of combination with the two of these, or maybe start with the compound, move to the fixed monthly payment one, or anything like that, just feel free to give us a call and we can always help you out with that. That is an option if you're looking to do that. And then this is a $10,000 minimum investment. Other than that, sky is the limit. So you can go as high as you would like. I do want to say again, this investment, it's not correlated in any way with the stock market or anything like that. So the principal value with this investment, it's never going to change. And I would say that's something most investors find incredibly valuable with this investment, is at the end of the day, you know exactly what you're going to be getting by the end of this 3-year term. And this is essentially exactly what I was just discussing. This is one of the main reasons that people look to invest. This is just a chart of the S&P 500 over the last 2 years. So as you can see, it's been moving quite a bit. We've seen a ton of market volatility. And this is something that I think can be very challenging for people, especially people who might be retired, close to retirement, anything like that, because they can't really be in a position where it might take their asset value 5, maybe 10 years to actually bounce back. So what they do is they end up looking for alternatives because they can't really put their money in most banks because typically rates of return are so low. So they end up looking for a little bit of a longer term just to get those higher rates. So I think this can be a great option for somebody who is retired, somebody who's looking to retire pretty soon here. I think this is something that I would highly encourage you to check out. So yeah, just in conclusion here, so this is our site here, Pinion Hill Capital. If you are interested, just check out our website. It's going to walk you through all those details. We can also just set up a phone call if you're looking to do anything like that. But it's very easy to set up. We would send you a DocuSign just going through all the investment details. You can also invest through IRA as well as non-IRA accounts. So if you have pension plans, a Roth IRA, anything like that, we do have third-party IRA custodians. So they can help out with the onboarding of that investment. And if you are doing a non-IRA investment, everything can be done online. But we can also help out if you need. But it's very simple. It typically takes 5-10 minutes. All we would do is send you a DocuSign. That's going to go over the investment details. And then from there, it's simply funding the investment. And you can do that through sending us a check, or you can do it with a wire transfer. If you are doing a wire transfer, let us know if there's a fee associated with making that transfer, and we can reimburse you for any fee with that. But yeah, as I was saying, typically it's very simple. Usually just takes maybe 5 or 10 minutes to get that set up. So yeah, that is just about it. I really appreciate everybody just taking the time to be here. My number, I can give you that out in case you want to reach me directly. I'm at 720-414-2006. So that's 720-414-2006. So you can call me or text me at that number anytime. I believe there have been some questions that have gone through so far. So I think we are good to go just to jump to the Q&A section.
Sure. Cole, thank you for that awesome presentation. And yes, let's get started with some questions here.
Yeah.
So what is the investment process and how long does it take?
So it's very simple. It typically takes 5, maybe 10 minutes. But all we would do, we would send you a DocuSign. And then from there, it's simply funding that investment. So as I was saying, you can just do that through wire or just sending us a check, just a blank check. And if there's fees associated, just let us know. And we can reimburse you if there are fees.
Are there any fees to get out early?
So if you're looking to get out before that 3-year term, there would be a 8% break fee. If it's some type of emergency for any reason, just let us know, and then there wouldn't be a fee associated with that.
Awesome. And what is the maximum that someone can invest?
Great question. So maximum we're able to raise with the SCE is $100 million. So other than that, 10,000 is the minimum. So you can essentially go anywhere in between.
Awesome. Can someone invest part of the money into the 10% and part into the 11% and still get the rate lifts?
Great question again. Yeah, so it's about the total investment amount. So for example, if you put 50,000 in each option, then the total amount of the investment would be 100,000. So you would still get that rate lift in that scenario.
Awesome. Can someone invest through any type of retirement account, such as Roth, SEP IRAs, or 401ks?
Yeah, just let us know. We have third-party IRA custodians, so they can help out with the onboarding with that investment. But yeah, we work with essentially any type of retirement account. So let us know, but we should be able to help out with that.
Awesome. And are there any costs with investing through an IRA?
There is no cost. Well, there sometimes there's a small fee associated with doing so, but we would reimburse you if there is any type of fee. So let us know if there is any type of fee and we can just reimburse you for that amount.
Awesome, awesome. Cole, I'm not seeing any more questions here. Is there any final thoughts you want to leave the audience with?
I think that is about it. I really appreciate everybody just taking the time to be here today. As I was saying before, if you're looking to get in contact with me or anything like that, if you have further questions that maybe didn't get answered or anything like that, just let us know. You can call me or text me anytime. And yeah, I'd be happy to chat with you.
Awesome, awesome. Well, that is it for today's webinar. Cole, it was a pleasure to host this webinar with you. And we do wish everyone happy holidays and peace be unto you.
All righty. Thanks so much. Thanks for having me.
No problem. Bye.
Thank you.